Imagine waking up, you pour your morning coffee, you check your retirement portfolio, and you just watch your absolute safest, your blue chip investments plummeting in real time.
Oh, yeah, that is a terrible feeling.
Right. And the catalyst for all of this financial destruction it's not a bad earnings report or some domestic banking failure.
No, not at all.
It is literally because a handful of small, fast attack boats in the Persian Gulf decided to pick a fight half a world away. So today is Tuesday, May 12th, 2026, and the global economy isn't just coughing, it is actively having a heart attack.
Yeah, we are witnessing the absolute definition of a systemic convergence.
Yeah.
I mean, the financial models that have dictated investment strategies for, gosh, the last decade, they're breaking down.
Because they were built for a predictable world, right?
Exactly. They were built for stability. And today, the world is anything but predictable.
Well, welcome to the deep dive. Our mission today is to map out all this chaos. We have a massive stack of intelligence to get through for you.
So much data today.
Yeah, it's heavy. We're pulling data from the Bureau of Labor Statistics' brand new April 2026 Consumer Price Index report that literally just hit the wire a few hours ago.
Fresh off the press.
Right. And we've also got fresh geopolitical briefings from the Pentagon, plus the analysts over at Geopolitical Futures.
And we can't forget the market breakdowns.
Exactly. We are integrating comprehensive market analysis from StoneX, The Motley Fool, and Trading Economics. Plus, we are tracking the live carnage right off the floor of the New York Stock Exchange.
The challenge for us today isn't really the volume of data, though. It's the connectivity.
What do you mean?
Well, our goal is to synthesize the why behind all these numbers.
Yeah.
We need to break down the underlying mechanics of how, say, a blocked shipping lane in the Middle East fundamentally dictates the price of beef at your local grocery store.
Oh, wow. Yeah.
And why that exact same blocked lane is about to dictate the interest rate on your mortgage.
Okay, let's unpack this. I want to start by looking at a map, because I feel like you really can't understand the financial math we saw this morning until you understand the physical geography of what's happening.
The physical reality is driving everything else.
Right. So the International Energy Agency is officially calling this the biggest energy crisis in history. And the epicenter is the Strait of Hormuz. The ongoing conflict between the U.S. and Iran has effectively shut down this specific maritime choke point.
And the geography there is just unforgiving. I mean, the Strait of Hormuz is roughly 21 miles wide at its narrowest point, which sounds like a lot.
Yeah, 20 miles is a decent stretch.
But the actual shipping lanes, like the deep water channels where these massive, heavy supertankers can safely navigate, those are only about 2 miles wide in either direction.
So it's basically a needle's eye.
It is a needle's eye. And through that needle's eye flows 20% of the world's daily liquid petroleum.
That is insane to think about. 1 in every 5 drops of oil consumed globally has to pass through those 2 miles of water.
Yep. And right now, that oil is trapped.
Totally trapped. And the escalation really tipped over a week ago on May 5th.
Right, the boat incident.
Exactly. According to the Pentagon briefings we have, U.S. forces destroyed 6 Iranian small boats. These were fast attack craft that were actively targeting commercial transit.
And the response was immediate. The waterway is now, and I'm quoting the maritime security alerts here, operationally constrained.
Which is military speak for nobody is sailing through.
Nobody.
Yeah.
And you really have to consider the mechanics of maritime insurance here. It isn't just that a ship's captain is physically afraid to sail into a war zone.
Well, I'm sure they are.
Of course. But the Lloyds of London insurance syndicates, the guys who underwrite these massive vessels, they have spiked their war risk premiums to a level that makes the journey mathematically impossible.
Oh, so it just bankrupts the voyage.
Exactly. If you are hauling $100 million worth of crude oil and your insurance premium jumps by a factor of 10 literally overnight, the cargo just sits in port. The physical tap has just been turned off.
Well, and the diplomatic avenues are looking equally locked right now. President Trump has been very vocal about the situation. He stated publicly that the fragile April 8th ceasefire is on, quote, massive life support.
He gave it, what, a 1% chance?
Yeah, a 1% chance of survival. He actually referred to Iran's latest peace proposal as garbage and totally unacceptable.
And look, just to interject here, as always, we have to note that we are looking at this strictly from an analytical standpoint.
Absolutely.
We aren't taking any political sides or endorsing any viewpoints from either the administration or Tehran. We are just impartially reporting the geopolitical realities and statements as they are detailed in our sources, because these statements literally move the markets.
100%. We just look at the data. And looking at the sources from geopolitical futures, Iran's strategic positioning here is super fascinating. From a purely economic and geopolitical perspective, their calculated bet is all about leverage.
They are playing a very specific long game centered around the American political calendar.
Right, the midterms?
Exactly. Iran's core demands are permanent control over the strait and basically an untouched pathway for their nuclear ambitions. And they know the United States is heading into midterm elections.
So they're weaponizing the calendar.
Yes. Their strategy assumes they can absorb the short-term domestic economic pain of an embargo way better than an American political administration can absorb the pain of soaring domestic gas prices right before voters head to the polls.
They are essentially treating their geographic position as a weapon of mass economic disruption.
That's a great way to put it.
Meanwhile, the sheer cost of keeping the American military in this theater is just exploding. I was looking at the Pentagon report, and the financial cost of this engagement has already hit $29 billion.
And they had to revise that up, right?
Yeah, they revised it upward just to cover emergency equipment repair and keeping the carrier strike group supplied. Which actually brings us to Defense Secretary Pete Hegseth.
The budget request.
Right. He is currently on Capitol Hill requesting a staggering $1.5 trillion budget for fiscal year 2027. And his explicit stated goal is to put the American defense industrial base on a wartime footing.
And we really need to examine the mechanics of what a wartime footing actually does to an economy.
Right, because it's not just a buzzword.
No, it has massive financial implications.
Yeah.
When the Defense Department requests $1.5 trillion to rebuild a hollowed-out industrial base, that is a massive structural inflationary signal.
Because the government starts buying everything.
Yes. The government is about to start competing directly with the private sector for raw materials. We're talking steel, semiconductor chips, aerospace-grade aluminum, skilled labor.
And the government doesn't bargain hunt.
Exactly. When the government is a guaranteed buyer with incredibly deep pockets, prices across the entire supply chain just rise. Furthermore, it signals to the bond market that the United States is preparing for a protracted period of global instability.
Okay, so we have the strait closed, and we have the military preparing for the long haul. Let's trace what happens to the ships that still have to move goods from Asia to Europe or the Americas.
Detour.
Yeah. Think of the Strait of Hormuz, and by extension the Red Sea, as a vital artery. If you put a tourniquet on it, the blood still has to flow somewhere, right? So these massive cargo ships and oil tankers are being forced into a colossal detour all the way around the Cape of Good Hope, down at the southern tip of Africa.
It's a massive reroute.
It's like a massive pileup on the world's most important economic highway. Everyone is taking the longest possible back road. And trading economics data shows that maritime traffic around the Cape is at its absolute highest level since 2025.
And this detour fundamentally alters the mathematics of global trade. I mean, sailing around the Cape of Good Hope adds anywhere from 10 to 14 days to a voyage from Asia to northern Europe.
2 extra weeks at sea.
Right, and that delay requires the ships to burn significantly more bunker fuel. It also means that vessels are tied up at sea for weeks longer than scheduled.
Oh, so you run out of boat.
Exactly. If a ship takes a month to return to its origin port instead of 2 weeks, you suddenly have a severe global shortage of available ships. Supply drops, and therefore, freight rates just skyrocket.
I was looking at the bunker fuel data from StoneX on this. Because all these ships are burning extra fuel on this massive detour, it's causing a major bunker fuel crunch over in Asia. The ships have to refuel somewhere.
And that fuel is not cheap right now.
Not at all. And this acts as a hidden, inescapable tax on absolutely everything that gets moved across an ocean.
Everything.
Right. It isn't just oil. It's electronics, it's clothing, industrial parts, agricultural equipment. Every single supply chain is suddenly paying this Cape of Good Hope tax. So let me ask you this. Is this just about oil, or is the disruption fundamentally rewiring global supply chains?
If we connect this to the bigger picture, it is absolutely rewiring everything. Which brings us to the technical Tuesday oil rally that's unfolding right now. The commodity markets are reacting violently to this physical bottleneck.
I saw WTI was surging.
Yeah, West Texas Intermediate, or WTI crude, which is the U.S. domestic benchmark, is actively testing $100 a barrel today. And technical analysts have $120 marked as a very realistic near-term target if this diplomatic stalemate persists.
Wow, 120. And
Yeah.
Brent crude, which is the international benchmark that prices seaborne oil, that's pushing even higher, right?
Yes, it's testing the $107 to $108 range.
And it's important to note for our listeners why they trade at different prices. Brent is heavily exposed to global shipping dynamics, while WTI kind of reflects the landlocked domestic supply in the U.S.
Right, so when Brent spikes noticeably higher than WTI, it shows just how starved the global maritime market is for physical barrels.
The pressure on the physical market is so intense right now. I mean, we are actually seeing the foundational alliances of global energy start to crack.
Oh, the OPEC news.
Yes. On May 1st, the United Arab Emirates officially exited OPEC. The Organization of the Petroleum Exporting Countries has dominated the global oil market for decades by coordinating production quotas. The UAE's departure is a seismic event.
It really is.
But why leave now, right in the middle of a crisis?
Because the UAE realizes that the old rules of the cartel no longer serve their national interests when their primary export route is literally blockaded.
Because OPEC is all about controlling supply.
Exactly. OPEC functions on collective bargaining and artificial scarcity to control prices. But if you literally cannot get your oil out of the Gulf because of an Iranian blockade, a production quota is completely meaningless.
Oh, I see.
Yeah. So the UAE's exit signals a profound lack of faith in the regional security architecture. It basically tells the market that every oil-producing nation is now acting entirely in self-interest. They are pivoting to secure their own alternative pipelines and export routes.
Wow. Okay, so we have established the physical reality. A massive maritime pileup, skyrocketing freight costs, an impending military buildup, and the fracturing of historic energy cartels. All of those physical actions have to translate into mathematical consequences here at home.
They eventually hit the wallet.
Exactly. And that transition brings us to the Bureau of Labor Statistics. They dropped their April CPI report this morning, and honestly, it is the mathematical manifestation of all the chaos we just discussed.
This is exactly where the geopolitical storm makes landfall on the American consumer.
Right.
The Consumer Price Index, specifically the CPIU, it measures the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. It is the definitive yardstick for inflation.
And the yardstick just snapped today.
It really did.
Headline inflation jumped to 3.8% year over year. That is a sharp increase from the 3.3% we saw back in March, and it marks the highest level of inflation the United States has experienced since May of 2023.
And the monthly numbers.
Looking at the month-over-month data, prices rose 0.6%. And the BLS report is incredibly explicit about the culprit here. Energy accounted for over 40% of the total monthly gain in the entire index.
And the granular numbers within that energy sector are just staggering. Gasoline prices are up 5.4% just for the single month of April.
Wow.
And they are up a punishing 28.4% year over year.
Almost 30% more for gas.
Right. And fuel oil, which heavily impacts home heating and industrial transportation, that jumped 5.8% for the month and an incredible 54% over the last year.
54%.
Yeah. Even electricity is up 6.1% year over year.
Here's where it gets really interesting, though. Everyone driving to work or paying a utility bill already knows that energy is wildly expensive right now.
You feel it every day.
Exactly. So the headline number jumping to 3.8% on the back of oil wasn't entirely a shock to, say, the analysts at StoneX or the Motley Fool. But what did catch Wall Street completely off guard this morning was the underlying data.
The core CPI.
Right. This requires us to look at core CPI.
Core CPI is arguably the most vital metric the Federal Reserve looks at. It takes the headline inflation number and it strips out the food and energy sectors.
Because they fluctuate so much.
Exactly. The rationale is that food and energy are historically volatile. A drought can spike wheat prices or, a war can spike oil prices, but those events don't necessarily mean the underlying structural core of the economy is experiencing runaway inflation. By looking at the core CPI, economists try to see the true, stable trend of price increases.
And the trend right now is terrifying. Core CPI rose 0.4% for the month of April and 2.8% year over year.
Which heavily exceeded Wall Street's expectations.
Heavily. This means the inflation isn't just isolated to the gas pump anymore. The 0.4% monthly jump is exactly double the pace of inflation we saw in both February and March. So, let me challenge you on this. We all knew oil was expensive because of the war, so why did this report catch Wall Street off guard? Shouldn't this have been priced in?
What's fascinating here is the concept of sticky inflation. Wall Street absolutely expected the energy spike, but they assumed the inflation would remain quarantined within the energy sector.
Like it wouldn't spread.
Right. But the core CPI jumping 0.4% means that the initial energy shock has successfully embedded itself into the broader service sector and into housing.
It's like a spilled cup of coffee on a rug. It starts in one concentrated spot energy, but if you don't clean it up quickly, it bleeds into the surrounding fibers, like core CPI things such as apparel, shelter, and full-service meals, and then it just stains the whole economy.
That's a perfect analogy. Let's walk through a real-world supply chain to show how this bleed actually happens. Let's look at the apparel index, which rose 0.6% this month.
Okay.
A clothing company isn't raising the price of a cotton t-shirt because cotton suddenly became incredibly rare. The price of the raw cotton material might be totally stable, but that cotton has to be harvested by tractors running on diesel.
Which is up over 50%.
Right. Then it has to be processed in a factory running on electricity.
Which is up 6%.
Exactly. Then it gets loaded onto a cargo ship that has to take a massive fuel-heavy detour around the Cape of Good Hope, paying astronomical freight rates.
The hidden tax.
Yep. Then it finally hits a domestic port and gets loaded onto an 18-wheeler again, burning expensive diesel, to reach a retail store or a distribution center.
So the costs just compounded every single step.
The clothing company absorbs those escalating costs for as long as they can, right? But eventually, their profit margins compress to the breaking point. They're forced to pass those accumulated logistical costs directly to the consumer.
Hence the 0.6% increase in apparel.
Yes, that is the delayed realization of the geopolitical chaos. The same applies to shelter, which is also up 0.6%. Construction materials cost more to transport, and the labor required to build homes demands higher wages to compensate for the higher cost of living.
It really is like dropping a massive boulder into a lake. The initial splash is the energy spike, but the waves propagate outward, hitting every shore. We even see food at home rising 0.7%, with beef specifically up 2.7%.
Right, because transporting that beef is suddenly so expensive.
Exactly. The cost of running a refrigerated truck full of beef across the entire country has fundamentally changed the price of dinner.
And this sticky, embedded inflation effectively assassinates the prevailing market narrative.
The hope for rate cuts.
Exactly. For the last several quarters, equities have been buoyed by this assumption that the Federal Reserve would eventually initiate a series of interest rate cuts in 2026. The market loves cheap money.
Everybody loves cheap money.
But a core CPI jumping 0.4% in a single month dictates that rate cuts are completely off the table. The economic reality has violently shifted back to a higher-for-longer interest rate environment.
I do want to dig into a few of the anomalies in the BLS shopping cart, just to be thorough, because inflation rarely hits every single item uniformly. There were some massive price drops hidden in the data.
Oh, the eggs?
Yeah, egg prices plunged 29.4%.
That is a fascinating reversion to the mean. We previously saw egg prices artificially skyrocket due to widespread portions of the laying flocks.
Right, the supply was decimated.
But the 29.4% drop shows that agricultural supply chains, when given enough time to recover from a localized biological shock, can actually stabilize.
Yeah.
The supply of hens returned, and the price cratered accordingly.
We also saw new vehicles fall 0.2%, and medical care commodities drop 0.4%. But, I mean, let's be real. These small victories are completely overwhelmed by the sheer weight of energy and shelter costs.
Oh, totally.
Saving $1 on a carton of eggs does not balance out spending an extra $100 to fill up your gas tank and heat your home. The consumer is still losing ground fast.
Which triggers a profound psychological shift in the financial markets. Wall Street spent Tuesday morning digesting the realization that the Federal Reserve is effectively trapped. The CPI report confirmed that the cost of capital is going to remain oppressively high.
And the market reaction was immediate and brutal.
A total sea of red.
The major indices took a severe beating. The Nasdaq 100 plunged 1.9%. The S&P 500 fell 0.6%, bleeding 44 points to close down at 73.68.
And the small caps suffered too.
Yeah, the Russell 2000 dropped nearly 2%, but the real bloodbath was in the tech sector, specifically the companies that have been riding that massive wave of artificial intelligence optimism.
The AI in semiconductor space has been the engine of market growth, heavily reliant on the assumption of infinite future expansion. But high interest rates act as gravity on high-growth valuations.
Let's look at the wreckage here. Micron Technology plunged 9.9% today. Intel dropped 4.7%. CoreWeave slumped 8%.
Ouch.
But the one that absolutely fascinates me is Broadcom. Broadcom fell 4.2% today, and they fell despite the fact that Citi analysts released a glowing bullish review and actively raised their price target this morning.
Yeah, that's wild.
I mean, Broadcom does incredible work, right? They design the complex networking chips that allow massive AI data centers to communicate efficiently. They are arguably at the very top of their game. So why are they falling? It's like being the smartest kid in class, but still failing because the teacher decided to curve the whole test downward. Macroeconomics is trumping microeconomics.
To understand why Broadcom's stock dropped despite stellar performance, we have to look at the mechanics of how Wall Street values a company.
Okay.
They use something called a discounted cash flow model, or DCF. A tech company is valued not just on the money it makes today, but on the massive profits it expects to make 5, 10, or 20 years from now.
Right. Future
Right.
growth.
But you have to discount those future profits back to present-day value. And the discount rate in that mathematical formula is directly tied to the interest rate set by the government.
So if the government is paying high interest on a risk-free bond, the math completely changes.
Exactly. When interest rates are low, money is cheap, and future profits look incredibly attractive. But when inflation hits 3.8% and the market realizes interest rates are going to stay high for the foreseeable future, the discount rate in those mathematical models skyrockets.
So the future looks less profitable.
An investor looks at the landscape and says, I can buy a virtually risk-free United States Treasury bond and get a guaranteed 4.5% return today. Why would I pay a massive premium for Broadcom's future profits when the risk-free rate is so competitive?
That makes total sense.
The higher the interest rate, the less valuable future earnings become. Macroeconomics completely crushed microeconomics today. Broadcom's brilliant engineering simply could not overcome the mathematical gravity of a hawkish Federal Reserve.
And we saw similar devastation outside of the tech bubble, too. Under Armour plunged 19.1% on wider losses.
Which goes right back to the closing analogy.
Exactly. This is the real-world consequence of that 0.6% jump in the apparel inflation index we talked about. Their supply chain costs are soaring, but consumers are tapped out, so Under Armour's profit margins are getting vaporized.
We also saw GameStop slip 1.9% after eBay rejected a takeover proposal.
Although it is worth noting that Zebra Technologies surged 13.6% on a genuinely stellar earnings report.
So there are a few winners.
Yeah, it proves that in a sea of red, exceptional corporate execution can still find buyers. But those exceptions are rare when the macro environment turns toxic like this.
Very rare.
While the equity markets were predictable in their panic, the commodity markets presented an absolute paradox today, and I really need to unpack this.
The gold situation.
Yes. We have inflation surging to its highest level since 2023. We have a literal war disrupting 20% of global oil flow. Historically, the textbook reaction to inflation and geopolitical chaos is a massive flight to safety, specifically to gold. Gold is the ultimate historical inflation hedge.
Yet gold has corrected violently. It dropped 16% from its January highs, trading down to around $4,700 an ounce.
Yes. If inflation is soaring, why is gold, the ultimate historical inflation hedge, actually dropping right now? Why is it crashing right when the exact conditions it is supposed to protect against are happening?
It seems counterintuitive, I know, but the mechanism makes perfect sense when you look at the bond market.
Walk me through it.
So, gold is a non-yielding asset.
Mhm.
It sits in a vault.
Huh?
It does not pay a dividend. It does not generate interest. Its only value is capital appreciation. Now look at what the oil shock did to the bond market. Rising oil killed the expectations for rate cuts. When rate cuts are priced out of the market, Treasury yields shoot up. The yield on the benchmark 10-year U.S. Treasury note hit 4.44% today.
So the institutional investors have a choice to make.
A very simple mathematical choice. Let's say you manage a billion-dollar pension fund. Do you hold gold, which yields absolutely nothing and actually costs money to store? Or do you buy a U.S. government bond that guarantees you nearly 4.5% interest every single year?
You take the 4.5%.
Exactly. As yields rise, the opportunity cost of holding gold becomes too high. Capital flows out of the gold vaults and into the bond market. Furthermore, these high interest rates attract foreign capital, which strengthens the U.S. dollar.
And gold is priced in dollars.
Because gold is priced globally in dollars, a stronger dollar mechanistically suppresses the price of the metal. The very inflation shock that normally boosts gold is currently creating an interest rate environment that makes it uninvestable in the short term.
That dynamic of high interest rates punishing the vulnerable brings us right back to the Russell 2000 index, which tracks 2,000 small-cap American companies. As we mentioned, the Russell took the heaviest beating of all the equity indices today, dropping almost 2%.
The vulnerability of small-cap companies lies entirely in their balance sheets.
How so?
Giant corporations like Apple or Microsoft are sitting on mountains of cash. They are effectively insulated from borrowing costs. In fact, they often earn more interest on their cash reserves than they pay on their debt.
Must be nice.
Right. But a small manufacturing company or a regional logistics firm does not have that luxury. They are highly leveraged. They rely heavily on borrowing to fund payroll, inventory, and expansion.
And the structure of that debt is the fatal flaw, right?
Precisely. A massive portion of small-cap debt is floating rate debt, meaning the interest payments adjust based on current market rates. When the CPI report confirmed that rates are going to stay higher for longer, the debt servicing costs for these small companies essentially doubled overnight.
That's brutal.
They are staring down a massive maturity wall where old, cheap debt comes due and has to be refinanced at today's punitively high rates. Investors did the math, realized these companies are going to bleed cash just to service their loans, and dump the stocks.
And the pain in the Russell 2000 is a direct reflection of the pain felt by the American consumer. Economists are calling the current landscape a K-shaped economy.
The K-shape, right?
Yeah, the letter K represents a stark divergence in economic fortunes. The top line of the K represents the wealthy. If you own your home with a locked-in 3% mortgage and you have a substantial equity portfolio, you are generally insulated. The inflation is annoying, but it isn't existential.
You might skip a vacation, but you aren't starving.
Exactly. But the bottom line of the K represents the lower and middle classes who are getting absolutely crushed by the compounding weight of rent, groceries, and gasoline.
The macroeconomic data on consumer health is reaching critical levels. Total household debt hit $18.8 trillion in the first quarter of 2026.
$18.8 trillion.
And at the same time, personal savings rates have dropped 1.5 percentage points from a year ago.
Because people are literally draining the emergency funds they built up over the last few years just to afford the 28% increase in fuel prices. They are putting groceries on credit cards that are charging 24% interest. It is a completely unsustainable cycle.
The market is hyper-focused on the upcoming data releases because of this.
Wow.
Later this week, we get the Producer Price Index, the PPI, which tracks wholesale inflation, and the retail sales report.
Those will be huge.
The retail sales data will be the definitive proof of just how badly consumer spending is deteriorating. If the consumer breaks, the K-shaped economy collapses into a full recession.
So to recap where we are, we have a geopolitical powder keg, supply chains in ruin, inflation surging, markets panicking over the cost of capital, and a consumer base running on financial fumes.
A perfect storm.
The sheer magnitude of this crisis demands a steady hand at the wheel. And yet, as if the universe decided we needed more volatility, a historic transition of power is occurring right now at the institution that controls the American economy.
The Federal Reserve is undergoing a profound regime change at the exact moment the system is most fragile.
The United States Senate just confirmed Kevin Warsh to a 14-year term on the Federal Reserve's Board of Governors. The vote was incredibly tight, 51 to 45, which reflects deep ideological divides.
Very tight margin.
This confirmation sets the stage for a massive shift, because Jerome Powell's term as chairman of the Federal Reserve ends this Friday, May 15th.
This Friday.
Yeah. Warsh is fully expected to be voted in as the new chair by the board on Wednesday. Now, Powell isn't leaving the building entirely. He will remain as a governor until 2028, but the gavel and the philosophy of the Fed is changing hands.
Kevin Warsh brings a drastically different perspective to central banking. He is a former Morgan Stanley executive who served on the Fed board during the 2008 financial crisis.
He's been around.
He has. And to understand the shift, we have to look at the friction surrounding this transition. Our sources note the historical context here. The Trump administration previously targeted Powell in a criminal probe. creating a deeply adversarial relationship.
Right, which we have to report on carefully.
Yes. During his confirmation hearing, Warsh explicitly stated he would not be the president's puppet. And again, just to reiterate for our listeners, we analyze this friction not to take a political stance whatsoever, but because it underscores the intense pressure the new chairman faces to prove the Fed's absolute independence while managing a crisis. We are entirely neutral on the politics.
Absolutely. It's just about the monetary policy implications. And the economic intelligence briefings outline what is being called the Warsh Agenda. It is a radical departure from the Powell era, and it's built on four main pillars.
Let's hear them.
First, a total reevaluation of how the Fed interprets data. Second, an aggressive acceleration in shrinking the Fed's balance sheet, meaning quantitative tightening, aggressively pulling liquidity out of the market. Third, depoliticizing the institution. But the fourth pillar is the most disruptive. Warsh wants to completely end the practice of forward guidance and encourage what he terms a good family fight, open public dissent at the Federal Open Market Committee meetings. So what does this all mean?
Well, the end of forward guidance is a monumental shift in monetary mechanics. For the last 15 years, under Bernanke, Yellen, and Powell, the Federal Reserve has operated on transparency. They telegraph their policy moves months in advance.
It's like bowling with the bumpers and the gutters.
Yes.
The Fed tells the market exactly when they plan to cut rates, when they plan to hike, and by exactly how much. They do this to soothe the institutional investors, to ensure that nobody gets a gutter ball of surprise volatility. The market knows exactly what to expect, so asset prices smoothly adjust.
But Warsh fundamentally rejects that philosophy. He believes that by constantly holding the market's hand and telegraphing every move to protect asset prices, the Fed has created a massive moral hazard.
A moral hazard?
Yeah. Investors take reckless risks because they believe the Fed will always signal danger ahead of time and ultimately step in to catch the falling knife. Warsh argues that forward guidance distorts true price discovery. He wants to rip the bumpers out of the gutters.
Wow.
He wants to force hedge funds and banks to actually analyze the economic data and take their own risks rather than waiting for the Fed to spoon-feed them the answers.
Okay, that sounds intellectually rigorous in a vacuum. But look at the reality of May 12, 2026. We are in the middle of the biggest global energy crisis in history. We just printed a 3.8% inflation number. If you remove the forward guidance bumpers right now, right in the middle of this chaos, aren't you just pouring gasoline on market volatility?
This raises an important question about philosophy versus reality. You are injecting pure volatility. The transition will be incredibly painful for a market addicted to predictable, cheap money.
I can't even imagine the swings.
Let's compare how the two regimes might react to today's CPI data. If Jerome Powell were retaining the chairmanship, his instinct would likely be to preach patience. He would look at the oil spike, attribute it to a temporary geopolitical shock, and argue that the Fed should wait for the Hormuz situation to resolve before making drastic moves. He would try to talk the market down.
But Kevin Warsh is looking at the exact same data through a very different lens.
Warsh is looking at that 0.4% jump in core CPI. He sees the inflation bleeding into apparel and shelter. His philosophy dictates that inflation is a cancer that must be eradicated aggressively before it anchors itself into consumer psychology.
So what does he do?
Well, Wall Street is currently debating whether the Fed will hold interest rates flat for the rest of the year. Under a Warsh regime, we have to seriously consider the possibility that he might advocate for an active interest rate hike before December. Yes. He might decide to intentionally induce a mild recession to crush the demand side of the economy and kill that embedded core inflation, regardless of the short-term devastation it causes to the NASDAQ or the small caps in the Russell 2000.
A rate hike in this environment would be an absolute shockwave. It shows a willingness to let the bowling ball go straight into the gutter to reset the foundation of the economy. But, as complex as the American dynamic is, U.S. inflation and monetary policy do not operate in an isolated vacuum.
No, everything is connected globally.
Right. To grasp the full scope of today's crisis, we have to zoom out. The decisions made in Washington are rippling outward, colliding with unique crises across the globe.
And the convergence of monetary policy and global logistics is heavily punishing Europe right now. The European markets bled heavily today. The German DAX, their premier stock index, fell 1.62%. The French CAC index dropped 0.69%.
But why is Europe reacting so much worse to the energy shock than the U.S.?
Europe has an acute physical vulnerability. Unlike the United States, which has a massive domestic energy production buffer in places like the Permian Basin, Europe is heavily dependent on imported energy.
Ah, they don't produce their own.
Exactly. When the Strait of Hormuz closes and bunker fuel prices spike, European industrial production takes an immediate, unmitigated hit to its core margins.
Hmm.
Joachim Nagel, the head of the Bundesbank in Germany, is explicitly warning the markets today.
What's he saying?
He stated that the European Central Bank might be forced into raising interest rates simply to combat this imported, energy-driven inflation, even as their manufacturing sector is already teetering on recession.
That's a nightmare scenario. And the Asian markets present a more complex, kind of fragmented picture.
They do.
The Shanghai Composite in China actually rallied, hitting an 11-year high, up 1.08%. Yet South Korea's KOSPI index tumbled 2.3%.
Why the divergent?
Well, the South Korean drop is driven by localized political action. Their government is introducing aggressive new measures to target and regulate profits within their domestic AI sector. It highlights how nations are fighting localized battles while simultaneously dealing with the overarching energy shock.
But the most terrifying global ripple isn't found in a stock index. It is found in the dirt. We have a silent crisis brewing in the agricultural sector, and it acts as the ultimate threat multiplier for global inflation.
You're talking about the USDA report. This is the piece of data that genuinely frightened me today.
It's grim.
The United States Department of Agriculture released their crop progress report, and the metrics are historically bad. 40% of the U.S. winter wheat crop is currently classified in poor or very poor condition.
40%.
Yeah. They use an index to track crop health, and the current score is 277. According to our agricultural analysts, that is the sixth lowest crop condition score recorded in the last 40 years.
And to understand the severity of this, we have to look at how agriculture connects directly to the energy crisis we discussed in Section 1.
How so?
You have a failing wheat crop, devastated by adverse weather patterns. To salvage what is left, or to clear the fields to plant a different crop, farmers have to run their heavy machinery. Tractors and combines run exclusively on diesel.
Oh, man.
As we noted, diesel prices are up over 50% year over year, due to the refining bottlenecks and the Hormuz closure. Furthermore, the production of essential nitrogen fertilizers is heavily reliant on natural gas, which is also served there.
So it is a compound fracture of the food supply chain. High diesel prices plus dying crops.
Exactly. The farmers are paying record-high input costs for fuel and fertilizer to harvest a historically poor yield.
Yeah.
The law of supply and demand dictates that the price of basic foodstuffs, bread, cereal, livestock feed is going to skyrocket globally.
And central banks can't fix that.
This is a pure supply-side shock. No central bank on earth, not Kevin Warsh, not the ECB, can fix a failing harvest by raising interest rates. You cannot print wheat, and monetary policy cannot lower the price of agricultural diesel. When food prices spike concurrently with energy prices, you historically see severe geopolitical unrest, particularly in emerging markets.
Which brings us to the ultimate climax of this entire narrative. The physical blockades, the inflation, the Fed transition, the failing crops, it all culminates in a diplomatic maneuver playing out right now. Because if the solution to this global gridlock isn't going to come from a hawkish Federal Reserve or a paralyzed Congress, where is it going to come from?
The solution might be thousands of miles away, orchestrated through the ultimate transactional diplomacy.
Right now, President Trump is flying to Beijing for a high-stakes summit with Chinese President Xi Jinping. But the ultimate wild card, the makeup of the American delegation, is the real story here. The president isn't just bringing diplomats and military advisors. He's bringing Apple CEO Tim Cook and Tesla and SpaceX CEO Elon Musk.
Bringing the titans of Silicon Valley to a geopolitical summit is a profound strategic flex. It signals exactly what currency the United States intends to leverage in these negotiations.
The stated agenda for the Beijing summit covers massive generational issues. They are scheduled to discuss global tech dominance, the establishment of AI ethics and frameworks, and the deeply contentious issue of U.S. arms sales to Taiwan.
Heavy topics.
Very heavy. But the urgent, immediate priority, the backdoor deal that could save the global economy, is a critical request for China to intervene in the Middle East. China is Iran's single largest buyer of crude oil, and they are Tehran's most vital economic and political ally. The U.S. delegation wants Beijing to use that immense leverage to force Iran to reopen the Strait of Hormuz.
It is a game of three-dimensional geopolitical chess.
Right.
The United States is walking into Beijing and placing its most valuable assets on the table. They're essentially offering access to American tech influence, concessions on artificial intelligence development, and potentially adjusting their posture on Taiwanese defense chips.
In exchange for what?
In exchange, they need Xi Jinping to unblock the Middle East so the American consumer doesn't drown in 3.8% inflation.
But let's look at this from Beijing's perspective. China relies heavily on global shipping for its export-driven economy. But they are also in a fierce race for AI supremacy. The strategic approaches of the two nations are completely divergent. The U.S. has taken a largely hands-free, unregulated approach to AI, allowing companies like Elon Musk's xAI and Tim Cook's Apple Intelligence ecosystem to innovate at breakneck speed.
Whereas China has done the opposite.
Exactly. China, conversely, has implemented draconian AI regulations, requiring all language models to be reviewed by the state for political sensitivity and security. So, does China have more to gain by letting the U.S. struggle with inflation or by stepping in to fix the Strait of Hormuz?
The calculation for Xi Jinping is complex. In the short term, China actually benefits from the U.S. struggling with high inflation and a volatile Federal Reserve. It weakens American economic hegemony.
Plus, they get cheap oil.
Right, China is currently able to buy heavily discounted, sanctioned oil from Iran while the West is locked out. But in the long term, a permanently disrupted global shipping network heavily damages China's export markets. More importantly, China desperately wants access to the unregulated American AI ecosystem to prevent falling behind in the technological arms race.
So they might actually go for it.
It is entirely possible they strike a deal. If Xi Jinping calculates that the leverage he gains over the United States in semiconductor access and Taiwanese geopolitics is worth more than the chaos in the Gulf, he will make the call to Tehran. It is the purest distillation of transactional geopolitics we have seen in decades.
The interconnectedness of this single day is just breathtaking. I want to briefly recap the incredible chain reaction of May 12, 2026, just to see the whole board one more time.
It's a lot to take in.
It starts with an Iranian conflict and the destruction of 6 small boats in the Persian Gulf. That leads Iran to blockade the Strait of Hormuz. Because the strait is blocked, 20% of the world's oil is trapped, forcing massive, expensive detours around Africa. Because of those detours, shipping costs and energy prices explode.
And because energy prices explode, the April U.S. inflation rate surges to 3.8%, and the cost of everything from beef to apparel skyrockets. Because core inflation is embedded, Wall Street realizes the Federal Reserve cannot cut interest rates.
Because interest rates are staying high, the hopes for rate cuts die, and the cost of capital crushes the valuation of high-growth tech stocks and highly leveraged small businesses in the Russell 2000.
The market plummets.
And right in the middle of this mathematical panic, a new, hawkish chairman takes over the Federal Reserve, threatening to rip away the forward guidance safety nets the market has relied on for a decade, which forces the President of the United States to fly to China, offering up Silicon Valley's finest innovations as bargaining chips to beg a geopolitical rival to fix a maritime blockade.
The defining lesson of this deep dive is the death of the old economic paradigm. For decades, the global economy was optimized for ultimate efficiency. Just-in-time supply chains, predictable inflation, and cheap money.
The easy days.
But in a K-shaped economy fractured by conflict, efficiency is a liability. The overarching takeaway for anyone listening to this, whether you are managing a pension fund, running a small business, or just trying to protect your personal purchasing power and savings, is that you have to understand these macroeconomic forces.
You can't just ignore it anymore.
No, you have to watch the price of diesel, the yield on the 10-year Treasury bond, and the maritime traffic in the Red Sea. We have entered an era where resilience has officially replaced efficiency as the necessary strategy for survival.
Resilience over efficiency. You have to build shock absorbers into your portfolio and your life because the bowling bumpers are officially gone. We started this session talking about a predictable machine that suddenly broke down, a dashboard flashing red with warning lights. Well, I want to leave you with one final provocative puzzle to ponder as you watch those flashing lights this week.
What's the thread?
If the ultimate solution to a Middle Eastern military blockade and crushing American domestic inflation isn't found in the halls of Congress or the boardroom of the Federal Reserve, if the only way to fix the American economy is to broker a backdoor deal in a room in Beijing, using the future of Silicon Valley's artificial intelligence as the bargaining chip, what does that fundamentally mean for the balance of global power for the rest of our lifetimes? Who is actually driving the car? It's something to think deeply about as you watch the markets open tomorrow. Thank you for taking this deep dive with us. We will see you next time.